When it comes to investing, it's not just about the theory. Practical experience is key. Sure, you can gather information from books, seminars, or even YouTube videos like this one. But the real magic happens when you dive into the practical side of things. And let's face it, you will make a lot of mistakes on the way just like I have. But the most important thing is to learn from them. In fact, the sooner you start, the more powerful the compounding effect becomes, which I will discuss later on in the video. Don't get overwhelmed by complex topics like PE ratio, stock buybacks, EPS, revenues, etc. It's not worth going crazy over at the start. Start by taking a small portion and dip your toes into the investment world. Gain some experience along the way and gradually build up your knowledge and your portfolio. You can begin with as little as just €1. That's right, your investment journey can kick off with just €1 per month. But to get started, you need to be able to take responsibility. Taking responsibility for your investment decisions is crucial. You should always be able to own up to the choices that you've made and be able to live with them. There's no one else to blame, whether it's a bank advisor or a YouTuber that you follow. The decisions that you make should come from your own understanding and conviction in the product that you're investing in. In the wild world of stock exchange, there's a famous saying that goes, "Why pay someone else to flush your money down the drain?" Seriously, who needs that? It's like paying a magician to make your savings magically disappear. So it's important to remember that making mistakes in investments is quite common. Remember, the ultimate goal is to make informed decisions and secure profits in the long run. But you can only do so if you understand your investments. Understanding what you're investing in may seem like a small thing, but it's actually a very common mistake in investing. Many people are attracted to advertisements that promise huge returns with little to no risk. However, it's important not to get convinced by those messages and always take your time to truly understand your investments. To make informed decisions about what you're about to invest in, it's crucial to do your research. Start by learning about investing in general by getting a broad understanding of how it works. If you're interested in investing in individual stocks, be sure to read the company's annual report and consider analyst ratings. On the other hand, if you're looking to invest in funds or ETFs, it's essential to read the corresponding prospectus for the specific product. Don't underestimate the power of knowledge when it comes to investing. By taking the time to read and educate yourself about your investments, you can make more informed choices and avoid potential pitfalls. Remember, it's your hard-earned money, so it's worth investing some time into understanding where you're putting it. This is where you also need to be skeptical. When it comes to gathering information about the stock market, it's essential to approach it with a healthy dose of skepticism. You could spend countless hours listening to stock market analysts or experts on TV channels, watching online videos and reading books from people who claim to be knowledgeable about stocks and valuations. Every day new forecasts emerge, but if they turn out to be incorrect, they are often brushed aside and forgotten. Sometimes a forecast might happen to be right by sheer coincidence and it gets blown out of proportion, making the expert in the stock market seem like a genius. But here's a question to ponder. If this expert is truly good, why would they sell their knowledge instead of using it to become a billionaire themselves? I'm not saying that there aren't people whom you can learn insights from, but it's crucial to be highly skeptical and question the motivations behind their predictions or recommendations. Always ask yourself, why are they making such claims and what can they stand to gain from it? So take in the information with caution, do your own research and make informed decisions based on a variety of sources. Trust your own judgment and do not blindly follow anyone's recommendations, especially YouTubers, as you do not want to flip-flop as most YouTubers do and think of a long-term strategy. When it comes to investing, it's important to have a long-term strategy in your mind. Over the long run, stock markets tend to have a positive return. However, it's important to acknowledge that there will be always ups and downs along the way. There might be times when the stock market crashes or prices decline, which can temporarily result in negative returns for certain investments. That's why it's crucial to have a patient and long-term mindset. Investing for the short term, like just 1 or 2 years in the stock market, doesn't make much sense. The chances of experiencing losses are quite high and they outweigh the potential for profits. Short-term buying and selling of securities is more like gambling rather than true investing. If you want to take a gamble on a short-term event or act up upon a hot tip that you've heard somewhere, remember, it's purely speculative. If you choose to do so, you can, but it's important not to use the money that you have set aside for your long-term investments. Keep your long-term investments separate from speculative bets. By having a clear horizon in your mind and staying committed to your long-term strategy, you can increase your chances of achieving your financial goals. You can do so by setting a goal. As someone who is learning how to invest, it's important to have a clear goal in mind. Be conscious of why you're investing and what you're saving your hard-earned money for. By having a goal, you'll have the foresight and motivation to stay committed over the long haul. One possible goal could be building up your assets for retirement. Thinking ahead and planning for a financially secure future can be a great motivator. Another goal could be working towards financial freedom, where you have the ability to live life on your own terms without financial constraints. Please hit the like button if you're getting value from this video and consider subscribing for more. That said, if your goals are more short-term, such as buying a new car in the next year or two, it's probably not a good idea to invest those savings in stocks. Short-term goals require stability and quick access to funds, so keeping the money readily available is a safer approach. So align your investment strategy with your goals to make the most out of your financial journey by following the diversification principle. I'm sure you have heard the saying, don't put all of your eggs in one basket. This also applies to investing. In other words, it's essential to diversify your investments. As mentioned earlier, it's highly likely that you'll make some not so great decisions along the way. However, the key is to ensure that one bad decision does not make a huge impact on your entire portfolio or investment amount. By spreading out your investments, you can effectively reduce the risk. But here's the thing, diversifying doesn't automatically mean that you'll have lower returns. It's important to consider different asset classes when diversifying. Instead of putting all of your money in stocks, you should also allocate a portion to cash assets, such as keeping some money in a savings account. Additionally, exploring other asset classes like bonds, real estate, or commodities can further enhance your diversification strategy. By diversifying your investment across various asset classes, you can create a balanced approach that helps protect your portfolio from potential downturns while still aiming for favorable returns. While diversifying your portfolio, you should also pay attention to costs. When it comes to investing in shares or other securities, it's important to remember that a profit isn't always what it seems. Taxes and inflation can cut into your gains. So even if you see a big green sign, it doesn't necessarily mean that you're in the clear. Let me explain what I mean by that. In the end, what truly matters is the amount of money that ends up in your account. Three things can take a cut from your investments. Firstly, there are transaction costs involved when you buy a security. These costs can reduce your overall returns. Second is taxes. Depending on the tax laws in your country, you may have to pay taxes on your investment gains. This can further eat into your profits. Lastly, there's inflation. Over time, the purchasing power of your money decreases due to rising prices. So even if you see a positive return on your investments, if it doesn't outpace inflation, you may not be actually gaining as much as you think. It's important to be aware of those factors and consider them when assessing your investment performance. Understand your tax obligations, aim for returns that outpace inflation, and keep an eye on transaction costs. When you buy and sell stocks through a broker, they will charge you a fee for their services. It's important to pay attention to this fee and try to keep it as low as possible. Comparing different brokers is a good idea, as online platforms usually offer lower fees compared to traditional banks. The choice of broker also depends on your investment strategy. If you're planning to trade frequently and speculate in the short term, buying and selling stocks regularly, you'll incur higher transaction costs. For example, here in Germany, you can start with €0 if you create a so-called savings plan with an online broker like Scalable Capital and Trade Republic. In this savings plan, you can auto-buy stocks or ETFs without any fee. This option can save you money if you want to invest for the long term, but even then you should expect losses. When it comes to investing, whether it's in the stock market or other areas, it's important to be prepared for the possibility of losses. Even outside the stock market, it's normal to experience occasional setbacks in your investments. However, it's crucial to understand that incurring a loss doesn't necessarily mean that your money is permanently gone. It's what we call a paper loss. For example, if you own a share that temporarily decreases in value, the loss is only realized if you sell it at a lower price. If you hold on to it and the value eventually rises again, you can even sell it at a profit. In the meantime, you've experienced a paper loss, but it doesn't mean that you've lost the money forever. Remember, investing involves ups and downs, and occasional losses are part of the journey because returns come from risk. With investing, risk and return go hand in hand, and it's important to understand the relationship between those two. The higher the potential returns you aim for, the higher the risks that you can potentially lose your money. Let's take a closer look at a stock that I held for a brief period. I bought some shares of Cassava Sciences at €2.57 and sold it at 10.08, making a 3x profit within just a couple of days. The stock value of this company went back to €5 in just a month. After that, the stock value jumped over €100. Had I sold it at the perfect timing, I would have made 50x profit. But consider it the other way. If I had bought the stock even at 50 euros and kept it till today, I would be in red because that company is trading below 20 euros right now. Let me know in the comments what would you have done if you were in my shoes. That said, I'm not suggesting that you should avoid investing in higher yield securities altogether. Rather, it's important to be aware higher yield comes with higher risk. Understanding and evaluating the risk-return trade-off is essential when making investment decisions. Consider your own risk tolerance, do thorough research, and weigh potential rewards against the potential risks. And whenever possible, try to reinvest your profits. If you're looking to grow your wealth and take advantage of the power of compounding, it's important to reinvest your profits. So what exactly is compounding effect? It's a phenomenon where your wealth can grow faster and faster over time. But here's the catch. This effect only kicks in if you don't spend or withdraw your profits from your investment account. In order to fully benefit from compounding, you need to reinvest your profits. Let's break it down. When you invest with the compounding effect, any profits that you earn are added into your initial investment. Over time, these profits start earning their own profit and the cycle continues. This compounding effect can significantly boost your wealth over the long term. Imagine you have invested 1000 euros and it earns a 10% return the first year, giving you a profit of 100 euros. Instead of spending or taking out this 100 euros, you invested back into your investment account. In the second year, that 1100 euros becomes the new base, and if it also earns a 10% return, you'll gain 110 euros in profits. The following year, the base increases to 1210 euros and so on. As time goes on, your wealth has the potential to grow faster and faster due to the power of compounding. So remember, if you want to make the most of the compounding effect and accelerate your wealth growth, that can only happen when you take the first step and actually start investing, which I share in this video. So thanks for watching Bleib Gesund, and I'll see you in this video.